Index funds, ETFs, mutual funds. If you've done any sort of research on getting started with investing, you've likely come across one or all of these. In fact, you've probably been recommended to invest in them. It's estimated that 40% of American investors and 20% of European investors own exchange-traded funds. But how many of them actually understand what an ETF is and how it differs from index funds or mutual funds? I'd wager not many. Now, you're probably asking yourself, why should I care? Can't I just invest in ETFs and remain ignorant to the differences? Of course, but consider this. If you're really serious about your financial future, don't you think you owe it to yourself to understand what it is you're putting your money into? You don't want to be that person who has tens of thousands invested in the market and can't answer a basic question about what it is they actually own. Plus, the financial world is only going to get more complicated, and so now more than ever, understanding the basics is critical. I want to start off with index funds, and I'm choosing to start with index funds for a very specific reason, which will become clearer later on. To understand what an index fund is, we first need to understand what an index is. In the investing world, when you hear the word index, more often than not, that's referring to what's known as a stock market index. Let's break this down very simply. The word index in the English language means a sign or measure of something. So when you hear the phrase stock market index, that literally translates to a measure of the stock market. But why would we want to measure the stock market? And what are we even measuring? If we think about the stock market itself, it's a place where company stock is bought and sold by investors all around the world. The stock itself is made available to investors on stock exchanges, of which there are many. The New York Stock Exchange and the Nasdaq in America, the London Stock Exchange in England, the Shanghai Stock Exchange in China, the list goes on. Clearly, on a global scale, the stock market is a very big place. In fact, the OECD reported that in 2019, there were approximately 41,000 publicly listed companies. Let's say we wanted to know how all of the stocks in the world were performing, or even the performance of company stocks from certain countries or certain industries. As you can imagine, looking at each company stock individually and aggregating the performance would take a very long time. Enter the stock market index. A stock market index is a tool which is used by investors to measure the stock performance of a particular collection of stocks. What stocks are chosen depends on what the purpose of the index is. Stock performance just means the increases and decreases in the price of stocks over a certain period of time. To answer our question from earlier about why we would want to measure stocks and what we're even measuring, we want to measure stocks to see the bigger picture, beyond the performance of any given individual stock. And we're measuring all of the stocks that we want to include in that bigger picture. This idea first came about in 1896 with the creation of the Dow Jones Industrial Average, an index which included 12 companies chosen to represent key areas of the US economy. The idea behind the Dow was simple: to give investors an easy way to assess the performance of the US stock market. Nowadays, the most popular stock market index in the world is the S&P 500, which tracks the performance of the 500 most valuable companies in the United States. This index is seen by investors as a representation of the US stock market as a whole, despite only 500 odd companies being included. That's because the S&P 500 covers 80% of the total value of the US stock market. So investors can look at the price chart of the S&P 500 to get an idea of how the US stock market has performed over time. But the S&P 500 is just one index that's available to investors. The FTSE 100 measures the stock performance of the 100 most valuable companies listed on the London Stock Exchange. The MSCI World Index covers 85% of the total value of the stock market across 23 developed countries. And the CBOE Volatility Index measures the expected volatility of the US stock market. Point being, stock market indexes come in all different shapes and sizes, and each with their own purpose. But perhaps the most important thing to understand is that an investor can't invest in a stock market index, but they can invest in a stock market index fund. Clearly, there's a link between stock market indexes and index funds. If we can measure the performance of particular segments of the stock market in isolation, we can also create an investment product which allows investors to partake in that performance. This was first made possible for average investors in 1975 by Vanguard, when they launched their first index fund which tracked the S&P 500. The premise is quite simple. You gather money from lots of different investors and you use that money to invest in the same same stocks which are being measured by a particular stock market index. How much of each stock you buy is dictated by what's known as the weighting of the stock within the index itself. For example, although the S&P 500 index includes the 500 most valuable companies in the United States, the stock performance of those companies do not have an equal effect on the performance of the index as a whole. Instead, the stock performance of the most valuable companies will have the greatest impact on the performance of the index. Apple is currently the most valuable company in the S&P 500, and therefore it is given the largest weighting at over 6%. So Apple's stock performance will have the greatest impact on the performance of the S&P 500 as a whole. Therefore, within an S&P 500 index fund, the total value of the fund's investments will be split in accordance with these weightings and will be adjusted over time as the weightings change. So what you get is an investment product whose returns are linked to the performance of the index which it tracks. This is why index funds are referred to as index-linked products. Index funds are fantastic investments for average investors. They allow you to gain exposure to the returns of lots of different stocks by simply making one single investment in a fund for one single price. Imagine if you wanted to achieve the same results without index funds. You'd have to go out and buy at least one share of each company that's included in the index, which would be very expensive. Yes, nowadays we have options like fractional share ownership, which saves you having to buy a full share, but you get the picture. It'd be both costly and time consuming to achieve the same outcome without index funds. Plus, with index fund investing, in particular index funds which track large segments of the market, there's no real need for carrying out any sort of extensive stock research beyond figuring out what index fund is the best fund for you. This is ultimately what the vast majority of the population needs: an easy way to invest while also minimizing the amount of work you need to do. Because let's be honest, most people have no interest in putting in the time that's required when investing in individual companies. So where do ETFs and mutual funds fit into all of this? This is where investors get confused. You see, index funds can be offered as either exchange traded funds, ETFs, or as mutual funds. In other words, an index fund is a type of ETF or mutual fund. So the real question is, what's the difference between ETFs and mutual funds? Before we talk about ETFs, let me just preface by saying that I have a video which covers literally everything you possibly need to know about ETFs. You will never need to watch another video on ETF investing after it, so if that's something you want, make sure to check it out. For the purposes of this video, I'll just be giving an overview of ETFs to highlight how they differ from mutual funds. An ETF is an investment fund whose shares are bought and sold on a stock exchange, just like regular company stocks, hence the name exchange traded fund. When you buy a share in an ETF, you gain exposure to the investment returns of all the different company stocks which the ETF itself owns. ETF share prices on the stock market are constantly changing, just like any other company stock. Mutual funds, on the other hand, operate differently. Again, these are investment funds. However, in order to invest in them, you need to do so directly with the investment manager who is offering the fund. In other words, you typically can't invest in most mutual funds through a stock exchange, with the exception of certain instances. For example, you can see here on Vanguard's website that I have the option to buy VFAX, which is one of their most popular index mutual funds, tracking the S&P 500. But if I wanted to buy VU, which is the ETF equivalent of VFAX, I need to do so using an online brokerage to access the stock exchange on which VU is traded. Unlike ETF share prices, which are constantly updating, mutual fund prices are determined once at the end of the trading day by reference to the net asset value or NAV of the fund. The NAV is simply all of the assets which the fund owns minus all of the liabilities which the fund owes. This is then expressed on a per share basis by dividing the NAV by the number of outstanding shares. This is the price at which mutual fund investments will be bought and sold each day. Clearly, ETF investing gives you more clarity over the price you'll be paying for your investment, given that the price information is updating constantly. Whereas with mutual funds, you have to wait and see what the NAV per share looks like at the end of the trading day. There's a common misconception that all ETFs are passively managed funds and all mutual funds are actively managed funds. When you hear the phrase passively managed, all that means is that the investment fund is an index-linked product, i.e. the fund is tracking an index and aims to provide its shareholders with the returns of that index. Actively managed funds, on the other hand, have dedicated fund managers whose job is to pick the stocks or other assets that the fund invests in. There's no index guiding the fund manager as to what stocks they should invest in. Investors in actively managed funds are looking for investment returns which are better than the market, i.e. better than the returns that passively managed index funds would provide. That's not to say that actively managed funds provide better returns in reality. In fact, we know that most actively managed funds underperform passively managed funds over the long term. Anyway, back to our original point. Both ETFs and mutual funds can be actively or passively managed. The ARK Innovation ETF is an example of an actively managed ETF, whereas the Vanguard S&P 500 ETF is an example of a passively managed ETF. On Vanguard's website for mutual funds, you can see that we can choose whether we want to filter by actively managed or index funds. That's actually quite interesting. Vanguard don't even use the terminology passive investing. They just replace it with index, which is probably more accurate. So we can conclude by saying that index funds are simply passively managed ETFs or mutual funds. If a fund isn't an index fund, then it's more than likely an actively managed ETF or mutual fund. So hopefully here at the end of the video, you now have more clarity over the differences between index funds, ETFs, and mutual funds. We didn't talk about whether ETFs or mutual funds are better on paper, or whether passively managed funds or actively managed funds make the most sense. If that's something you'd like to see in the future, let me know in the comment section. If you want to keep up to date with the financial markets in the same way that I do, check out the first link in the description for 50% off Seeking Alpha. If you're from Europe and want to get started investing in ETFs while also grabbing yourself some free shares, also check out my links for Book Zero, DeGiro, and Trading 212 below. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!